Well, it's pretty hard to find anybody willing to come to Eliot Spitzer's defense right now, but is that really fair?
Spitzer did take on Wall Street at a time when a little law and order was necessary. Does he deserve at least some credit for this? Our Fox panel is here to debate that point, including Peter Schiff, author of Crash Proof, Terry Keenan from Fox News, Gary Kaltbaum from GaryK.com, and Victoria Barrett from Forbes. Good to see y'all. Terry, first to you if I can. Even those who praise him say, or praise what he did on Wall Street, say that his style was wanting, that he very often would skirt sort of usual methods that prosecutors are expected to take in order to go after his prey.
He was a steamroller. That's what he called himself, you know. But Wall Street isn't a tea party, and I give him a lot of credit for what he did. He went after a lot of the abuses in research and what was going on in the IPO markets, where essentially IPO shares were being given out to CFOs, and there was this whole daisy chain.
Initial public offerings that he needed some little regulation there.
He cleaned up the New York Stock Exchange, and believe me, you could talk to hundreds of members of the New York Stock Exchange who were essentially ripped off by the management there, who would thank Eliot Spitzer for what he did. Now, his personal peccadillos came back to haunt him. I have a feeling that some of his enemies were out there looking for them, but you know, we may never know that.
Gary Kaltbaum, let me bring up this analyst situation that Terry referenced, and there were a lot of shareholders and a lot of people who were clients of, say, Merrill Lynch, who listened to the research that Henry Blodgett, the analyst of the dot-coms at the time, was giving out. Spitzer discovered that analyst research was completely tainted. Basically, he was saying that things were better than they were just so that the companies would give their investment banking research to Merrill Lynch. Do you see any good out of what Spitzer got, and is it all erased now after what happened yesterday?
Well, look, I think everything he's ever done in the past that was good goes by the wayside now just because this is going to stay in the headlines. But I give him a lot of praise for what he did. I talked about it on my radio show for many a time. Guys like Henry Blodgett with strong buy recommendations and then emailing friends saying this stock is a piece of crap. So he did a lot of good. He opened up a lot of things for people to look at. The one thing he obviously didn't get done is these funds that are margins up 20 to 1, lenders lending out money 20 to 1 on margin. I wish he would have done something on that, and we wouldn't be in this position right now. But I think he did a real good job. Bad form, a little bit too over the top, but I think he looked at a lot of things that needed to be changed.
Well, Victoria, just to be specific about what kinds of things he did, he was interested in changing the structure of AIG, the big insurance company. He went after Hank Greenberg, who was the CEO, was anxious to get him out of that top position. He went back to a 30-year-old story that suggested that somebody was playing around with a private foundation with which Mr. Greenberg was associated, not being specific, but suggesting, putting out the notion in the press, and you know how hungry we are for news, that perhaps he did something wrong. It wasn't true. He hadn't done anything wrong. In fact, Hank Greenberg has given hundreds of millions of dollars over the years to a lot of foundations, but there was just enough stuff out there to make Greenberg worry, and eventually he stepped down.
Yeah, he stepped down largely because he had to. What Spitzer could do was basically hold boards of large companies up for ransom and say, look, if you don't settle, what's going to happen? We're going to press criminal charges. Your credit rating is going to fall through the floor. And guess what? If you're insurance, that's not a good, in the insurance industry, that's not a good thing. He went after the money. What's less clear to me is how much good he did in terms of reforming Wall Street. He certainly instilled a lot of fear into the place, and it's a place that's pretty long on greed and a little short on fear. But what's the lasting good that he's done?
Well, I mean, if he was in Peter, you could say that he separated investment banking from the analyst research side. Could you not? At many financials.
Well, look, he was definitely on the right track. I don't think he went far enough in what they were doing. I mean, look at what's happened with the subprime mortgages. I mean, it shows that there's a lot more conflict on interest on Wall Street than even he was able to uncover. But, you know, unfortunately, when you're in a position of power, when you're a governor, you know, especially how he came to office, I mean, other than the sheer hypocrisy of what he's done, you need to put yourself on a higher standard. You can't do stuff that puts you in a position. What if somebody had found out about this? What if they blackmailed him? What might he have done? And this is what they found out. They busted him on this. Who knows what else the guy's been doing? So, you really can't do that when you're in charge of the public funds, when you control the purse strings and you're in the legislature. You really got to put yourself up on a higher price.
Terry, prosecutorial excess is something we've seen a lot of recently, not just in the world of finance, but also in criminal law as well. And it is something that one has to be very careful about monitoring in our society.
It is, and in most cases, Elliot Spitzer did get his man. He was able to make the case or to settle, but you're right.
Always settled. He never brought a case into court in front of a jury. He always settled before, because he'd throw these little tasty bits of information out there for us in the press to get hold of.
But in lots of cases, he was on the right track.
On the right track, but again, prosecutorial excess, I just wonder.
Well, you know what? He did settle a lot of these cases. People are scared. I think they didn't want to go to trial with him.
But you know what? Unfortunately, I don't think anybody's learned a lesson from him. As we move away from that, I still remember New York Stock Exchange, how the board of directors were like Dick Rasso's, bridge buddies, and I think the same thing's happening now in a lot of places. And I think that's got to be changed down the road.
All right, thanks to our panel on that. In the blink of an eye, just like that, Spitzer. Boy, oil closing for the day in New York. Each time you wonder, can it get higher? And again in record territory, settling at $108.72 a barrel. That's up 82 cents, David.
Yeah, it is amazing. It's reaching those levels where it really is of some concern to people whose businesses rely on it. I was talking to the head of Skybus, a new low-cost carrier, saying that if it gets much higher, his business is going to be out of business.
Good afternoon, everybody. I'm Liz Klayman.
And I'm David Asman. Near session highs after the Fed makes $200 billion available in loans to some of those troubled Wall Street banks, even overseas.
That's right. The helicopter run by Ben Bernanke at the controls, just dumping cash all over the markets. The Dow responded very positively to that today, and we have the Dow Jones Industrials up about 265 points, getting closer, believe it or not, back to the highs of the session. But at the moment, the Dow stands above 12,000 at 12,005.
The NASDAQ is also up. All of the indices are up over 2%. The one that is climbing the most, by the way, is the Russell 2000. Small and medium-sized companies that are desperate for cash. Nobody is hit more by the crunch than they are. They are doing it particularly well, 2 3/4% as a whole, up right now.
And gold up $1.60 at the moment to $973.40 a troy ounce for the yellow metal. There it is, up just another fraction today.
So it seems like just about every day oil hits a new record, but how long can it last? At this point, you have analysts out there saying it could gush to $200 a barrel, and others who think it could slide back down to the 90s or even the 80s.
I'd love that.
Yeah.
I'd love 50.
All.
We brought together two of our own Fox panelists with differing views to talk about why they feel the way they do about gold, and oil rather. Eric Bolling thinks we could see a pullback. You'll find out how much in a second. Peter Schiff says the sky is the limit. Eric Bolling, I can't believe it. You think it's going down. How far?
Well, look, I think I agree with Peter. Believe it or not, I don't want to say that too often. I think I've said that twice this year, which is a problem.
You can. No, it's
look,
not.
There's no stopping oil. There's no stopping gold. There's no stopping physical commodities. I mean, these are areas where people want to put money, and they will continue to go. But any good bull market has a pullback. And the thing about this bull market, we've run up 24% this year already. It's just almost parabolic straight up. It needs a correction. And when they asked me, what do you think of oil? I said, well, I think it can trade 85, but I also think it can trade 120 in a short period of time, or 130, maybe even 150. But that's a normal bull market. Let me transfer this one point over to you real quickly. Yesterday, oil was up almost $3 a barrel. Gasoline, Liz, 1 penny higher only. So this is not translating into higher prices at the pump. So don't freak out if you're seeing a higher.
It climbed 6 cents recently.
It climbed 6 cents, but it's not up 120% of it. By the way, we're up 24% in oil. We're maybe a little higher in gasoline on the wholesale level.
Well,
so
Peter,
far,
you would say the focus should not be oil. The focus should be on the dollar and its value.
Well, of course, that's what's driving oil prices. It's a reflection of the value of our money. And when you have Bernanke, rather, doing what he's doing today, he virtually guarantees that oil prices go much higher. But I think where I disagree a little bit with Eric is in the short run, I think that 100 level, which was a triple top, and there was a lot of consolidation there for a few few months, I think you built up a lot of people short the market, a lot of stops above 100, and I think there could be a little bit more distance between 100 and where this current rally goes. Maybe we go up to 120 or a little bit higher before we get a big pullback. There's probably going to be a pullback, but you got to buy that pullback.
Could there be a pullback if Bernanke continues to cut rates?
Well, he's doing that.
If you say the phenomena of oil prices so dependent on the value of the dollar.
Well, it's not only the dollar. It's the value of the euro and the yen and all the currencies. The renminbi. Every central bank around the world is creating too much money. They're printing a lot of money. We're the leader of it. We're starting it with the dollar and exporting it around the world. But as long as they're doing that, prices are going to rise.
May I throw a little bit of water on you? I agree with you. A weak dollar is definitely bullish to commodities, or anything traded in the dollar goes up when the weak dollar goes down. But Peter, the dollar is down 12% in 1 year's time. Explain how you can account for a 120% rise in the price of oil.
That's what I'm trying to say.
A 12% decline in the dollar. Yes, it adds to it, but this is money flow. This is just money looking for a home. When the housing market is weak, when the equity markets aren't where you want your money as an investor, as a big money manager or mutual fund, you go towards the hot commodities.
Let me answer your question. Because what's happening is central banks all around the world are looking at the dollar weakness and trying to manage their own currencies. They're trying to prevent their own currencies from rising too rapidly against the dollar. So they're inflating too. Everybody's money supply is growing.
Excuse me. Let's get it. Guys, let's get it back to oil because
this is oil.
I understand that, but you've got to talk to the viewer out there who sees that it's $108, is thinking, number one, how can I ever afford to fill my tank in the future? Number two, is this the investment to get in on right now? Will it go higher?
Well, sure. Look, the dollar is going to lose value, so everything is going to go up relative to dollars. I mean, even stocks are going up, but they're not going up as fast as commodities, as gold, as oil, as foreign currency. So what Americans need to understand is their purchasing power is being stolen from them by the Federal Reserve. They need to take actions. They need to protect themselves. If they want to be able to afford oil and afford food, they better get rid of their dollar savings. They better reallocate their investments and get their money abroad. Get into these commodities. Get into foreign assets.
Great idea. Too late, though, Peter. These are money flows. I keep talking about it. You're going to see situations where when the dollar finds a low, and it will. I mean, it almost feels like it's getting there right now, at least short term. That money is going to flow out of commodities. It's called, that carry trade, that reverse carry trade. It's going to flow out of commodities and back into the things that really where they.
By the way, a very important speech by the president this week here in New York, where he is being pressured to come to the support of the dollar to encourage foreign currencies to get involved in the dollar, drive up its value. Do you think it'll work?
There's a lot of people that are calling for a strong dollar, but what is it going to take? It's going to take higher interest rates, a reduction in money supply.
The Treasury can't do anything on its own without the Fed.
It has before.
What do they do? Talk?
No, they can talk the ECB. They can.
Bob Rubin would disagree with you.
But the cooperation with the ECB to lower rates.
No, they're not going to do that.
ECB rates.
Look what they said today.
Then there's not so much a safe haven of borrowing.
There is a way to prop up the dollar, and that is to buy dollars and make them rarer on the market.
But with what? The Treasury doesn't have anything to buy them with.
Foreign banks do. Foreign central banks do, and we have in the past pressured them to buy up dollars.
What do you think China's doing now in Saudi Arabia? That's why they have these inflation problems.
Well, there are European countries that have been encouraged to do so. So far have not.
But they won't.
And the question is whether they will.
Maybe today, with that, they talked about this morning, that stimulus package or the injection of liquidity by the Fed in cooperation with the ECB. Maybe that's opening the gate.
Well, I don't know what it's going to take for people at the Fed or the Treasury Secretary to understand that a dollar this week isn't necessarily a great thing for the United States.
No, it's never been a good thing. But why would the ECB, if they're fighting inflation, right? They've got an inflation problem. Why are they going to add fuel to the fire? Why are they going to deliberately base the euro?
For one reason.
Create more inflation?
If they don't, they risk the global economy slowing down.
No, they don't.
Oh, sure they do.
No, they risk our economy slowing down. The rest of the world can do just fine.
Guys, hold on a second.
Gentlemen, come back. We like the discussion. We were getting somewhere. We appreciate it. Meanwhile, speculators are playing. Well, even though the market is doing terrific today, the Dow Jones Industrial Average is up 291 points right now. It's been such a rough year for the market so far. It's hard to find anybody suggesting investors move back into this roiling stock market.
However, our next guest suggests may at least be time to dip your toes in the equity ocean. Although specific equities. He's Alec Young, equity analyst for S&P, the company that just upped its rating of U.S. equities from underweight to neutral. Hi, Alec.
Hi, nice to be with you.
What is it about U.S., I believe it's large cap equities you like right now? What is it about those that you say makes it time that they're a little bit more attractive at the moment?
Yeah, a few days ago we moved to neutral from our underweight view on the U.S. market, which had been in place for a couple of months. We think valuations have gotten pretty compelling, and although we continue to get buffeted by bad news out of the credit markets, today's news with the Fed being willing to step in and exchange treasuries for a lot of the more illiquid credit securities, asset-backed securities with broker-dealers, we think that's really good news on the credit front. So we've got a decent equity rally going here. So we think there's reason to get a little more constructive on U.S. stocks here.
Alec, are you at all concerned that some of the bad credit on the bank's books is now being moved over to the Federal Reserve because they're taking as collateral a lot of the subprime mess that nobody else wants? The taxpayer essentially now owns it.
Sure. I mean, that's definitely an interesting question, and I think that that's going to get probed more in the days and weeks ahead. But for equity investors, their main concern was the fact that it was on the books of publicly traded companies. And so, obviously, that had a more negative impact from a stock market perspective than shifting that risk more over to the Fed. But certainly, the Fed, while they're certainly in a stronger financial position than a lot of private companies, they can't take, an unquantifiable amount of risk. So that's something that we'll have to look at more closely. But right now, we're just glad that they've stepped up and provided a much-needed relief valve in the credit markets.
Well, Alec, though, we're not trying to tell people, I believe your message is not to be a blind dog in a meat house and just start eating everything. Specify it if you could. What do you like right now in particular?
Well, all year we've been more focused on defensive areas, things like consumer staples, things that people are going to need whether we go into recession or not. Thankfully, we've been staying clear of financial companies, tech companies. We pretty much continue to recommend a pretty cautious outlook at the sector level. We think there's reason to believe that the risk-reward is getting better overall, but we're certainly not out of the credit woods. We'd like to hear specifics from some of the impacted companies, the big investment banks, the money center banks.
So would we.
letting us know that in fact this new Fed action is going to have a materially positive impact on their outlooks before we get a bit more aggressive on the more cyclical areas of the market.
All right, let's bring our panel in here. And Peter, what do you like at this moment?
Well, I like the foreign markets. I like the commodities. I mean, I haven't just been underweight in the U.S. I've been zero-weighting the U.S., and I've been doing that for years. I mean, I got a couple of oil and mining stocks here, but in general, you want to underweight dollar-denominated investments and overweight everything else. So you want to invest abroad. You want to invest in the companies that are going to profit from the growing purchasing power of foreigners, not the diminishing purchasing power of Americans. And, when you invest abroad, you get much lower PEs, you get much higher dividend yields, and you get dividends in currencies that are going up.
So, Alec, can you respond to that end? Do you agree with anything Peter says? I mean, counter that.
Sure, to a certain extent. I really don't agree with it this year. I mean, one thing we've seen is after several years of strong outperformance of the U.S. by the international markets, both developed and emerging, they've really tanked this year. They've been able to weather a bit of slowing in the U.S., but with the U.S. heading into recession, people have really run for the hills in European stocks, Japanese, even in the emerging markets. I mean, they've decoupled to a certain extent, but if the U.S. economy really starts nosediving into recession, I think it's naive to think that you can make a ton of money in overseas stocks.
Well, it's not naive. I'm actually doing it. I mean, I think if you look at the emerging markets, and I would agree that some of those stocks went ballistic, and so those have come down quite a bit. But I can look at my own client accounts. If you look at the conservative, yield-oriented stocks that we own around the world, they're actually doing still pretty good. They're outperforming the U.S.
And Terry, you got to. I always like to buy American whenever I can, but when you look at the value of the dollar plummeting and you don't see any end in sight, at least in the near term, you wonder whether maybe Peter's right on that.
Yeah, I mean, you want to get paid in those foreign currencies. You want your dividends in those foreign currencies. Repatriate them back into dollars because the dollar is being devalued by the day. And, a lot of people say we see the end in sight, but they said that at the end of last year. This was supposed to be the year of the dollar. And with the Fed dumping $200 billion, every Tuesday on the market, I don't think that the dollar is really going to rally. And I find it hard to make a case for the U.S. market overall. I think it's oversold. We were down 17% from the highs as of yesterday, but you have the financial sector in the dumps, you have the housing and housing-related sector in the dumps, you have the consumer in the dumps, tech. That's 75% of the market.
Victoria Barrett, do you see Alec's side of this? Because everyone's ganging up on Alec.
Well, here's the thing to remember. When you're investing, you're thinking about future earnings. And at some point, we look out and we see much healthier earnings. I'm not calling a bottom. If I were to call a bottom, I'd be running a hedge fund. But at some point, U.S. earnings will reach a point where and valuations have come down pretty far, that U.S. big equities are going to be a great investment.
All right, Gary, we haven't forgotten about you, but we're up against a hard break. We'll get you in twice the next time, we promise. Now, if stocks are not...
The Fed's latest move, making $200 billion available for easy loans to the financial markets, has juiced the equity markets, as you just saw. Dow is up 349 points. But overall, if you look at this big picture, will it ease the credit crunch or simply fuel the fires that were started by easy money in the very first place that was out there?
I saw Peter Schiff just go, Yeah. Our Fox panel is back now to talk about it. Just because you were so demonstrative, I'm going to throw that to Gary Kay. Gary?
And what would you like to know?
Is it, first of all, is it good or bad what the Fed did today?
Look, short term, the market's up 350. For everybody, that'll be good. But look, since the Fed started sending the zillion, drillion, billion dollars into the economy back on September 18th, the S&P's down 15%, gold and oil are up between 30 and 40%, and the dollar's down 12%. So the markets are not happy what he's doing. All these short-term things, terrific for the market for a few days, but long-term, you are sowing the bad seeds of monstrous inflation going forward. And I just think the Fed remains 6 to 9 months behind the curve, and I think they have absolutely no control in the long run, unfortunately.
Terry, today's move, does that trickle out over the long term, or is it just a short-term move?
You know, there's an expression they used to use in Japan, pushing on a string. That's what seems to have been happening, because we've seen a series of these cash infusions, and as Gary said, the market's still down 15%. Inflation is a huge problem. I mean, Peter and I were just talking about the cost of getting a prostitute these days. I mean, look at the inflation. I mean, really, this is what
something on our agenda every week.
Worrying about.
Well, Spitzer was what? It was $4,500 for 2 hours. So. I don't know what it
I think it was
cost.
4, not to be too technical about it. But Peter, go ahead. What are we going to do? The Fed seems determined to continue to do everything it can to, as they say, pump liquidity back into the credit crunch. Is there any chance it'll work?
Well, look, how many times have we seen since this crisis began, the Fed comes up with some major announcement of additional inflation, and the market runs up in the open a couple of 100 points. Shorts cover. People think it's a big deal, but look where we are today. You know, all their
300 plus points.
Look where we are today relative to where we were when they started. These rallies fizzle out. All the government is doing, all the Fed is doing, is trying to combat the problems that it created with inflation in the past with new inflation in the future. And it's not going to work. Unfortunately, there's no bubbles left in our economy to inflate.
Victoria Barrett, I got a bad feeling about this $200 billion. I'm sure the banks love it, and it would loosen the tight credit situation at the moment. But I'm looking at the inflation out there, just at the grocery store, everywhere. Everything is more expensive. And could this possibly somehow moderate or temper what we see out there as far as inflation is concerned?
Well, I don't think this is going to impact inflation in a positive sense, if that's what you're asking. It's a steroid shot for the economy. You know, Hank Paulson was out here at Stanford speaking last week, and he said our first priority is moderating the spillover effect. They don't want the housing crisis to affect the general economy. This seems like kind of a measure that would aim to do that. What else can they do? I mean, they're trying creative approaches. You got to give them credit for that.
Well, one thing that they could do, and I don't think they're going to do it because we're in an election year, Peter, and there's no political will to do it, is to try to squeeze inflation out of the system, which would hurt very badly, and at the same time lower the cost of production by lowering tax rates even more.
Well, of course, but you know, how can you stop the housing market implosion from spilling over into the overall economy? I mean, it is the overall economy. The average American has been spending his housing wealth. When that wealth is gone, how can it not impact the economy? When your biggest asset is your biggest liability, and especially when you have all these Americans with arms, and as these mortgage rates are resetting higher, how can your mortgage payment, your biggest monthly expenditure going up by 20%, 50%, not impact the overall economy?
Gary Calhoun?
Yeah, but Peter,
I want to make
Gary.
an important point about this here, which I really do hate, is that the Fed is rewarding and helping out bad behavior. When I see a Carlyle group that had $300 million in equity but margins up to $22 billion, somebody actually lent that money. Both sides of the equation is bad behavior. Yet the Fed is trying to bail them out here. I say let them go by the wayside. Let them take their losses. Don't be nice to them. I just don't like who they're trying to help
is the
here.
Fed bailing out Wall Street at the expense of Main Street?
Yeah, they are right now. I mean, Gary's right. 30-to-1 leverage. I mean, that was supposed to stop
Ridiculous.
after long-term capital. And I'm sure Carlyle's probably one of the more conservative out there, you know? So it's a mess.
Remember, these guys were making a ton of money off that leverage. These hedge funds were leveraging up because they were taking 20% of the profits. So they had a big incentive to gamble with other people's money.
In other words, when you say that, what you're saying is, in other words, they were borrowing on top of bad debt. And when that bad debt crumbled, so did their borrowing.
And what most hedge funds were doing, they were getting rich not off of good performance, but just off of leveraging up mediocre performance. And while the bets were going their way, they made millions or billions.
Gary?
But now they're blowing up and their shareholders are getting clobbered.
I've said it before and I'll say it again. This is like that poker table at One Flew Over the Cuckoo's Nest with Danny DeVito and Jack Nicholson. Nobody knowing how to play the game and
You and I
everybody
are
giving
the only
each other.
ones old enough to remember that, Gary. All these youngsters don't remember.
See, it's a
Victoria, I wanted
classic.
you to go ahead. You wanted to chime in, Victoria. We've been short shrifting you.
Well,
Go ahead.
Peter really creates this doomsday scenario, but for most people, you know, their houses aren't in foreclosure. They don't have subprime loans. What the Fed and Washington in general should do in this situation is try to ease the credit crunch so that regular businesses can still get funds. That's where the real jam can be created, and that will really slow down the economy
But they
for
don't
a long,
ease it
long time.
by
You
creating
cannot
money.
force an ease. You cannot force the ease. The markets have to force the ease over time. If you do
But they're
too
trying
much,
to address
you can
the issue
create
of
problems.
fear.
But you
They're
don't
trying to address the issue of fear here, and I think you got to commend them for that. Look, I agree with lowering rates has been a bad policy, but this seems like a creative attempt to ease the credit squeeze.
You can't ease it. You know what we need? We need more savings. Legitimate credit comes into existence because people don't consume.
Well,
they save money.
I don't think, you've traditionally not seen Americans with a very healthy savings rate. In fact,
That's
it's been
part of the problem.
negative rate.
That's why we're in this mess.
Well,
because we
that's
didn't
one
save.
thing Alan Greenspan used to decry, Terry. He used to say we need a better savings
used to
rate.
have equity in their homes, more equity than they had debt, and they used to put down 20% or more, and that's all gone out the window.
And that went out the window partly because of Alan Greenspan keeping rates down so low for so long.
And encouraging people to take out ATMs
Making easy
when he
exactly
knew he was
possible.
going to raise rates. So
All right.
Thank you.
More on this to come. Well, there could soon be a new government.
Whether he was considered friend or foe, Elliot Spitzer's presence definitely loomed very large on Wall Street.
So how is it going to affect markets if he steps down? Our Fox panel is back now to talk about it. Victoria, let me go to you first. This is a guy who's had a lot of notches on his belt. As I mentioned before, none of the cases that he brought, none of the decisions that were made were on the basis of a jury trial. A lot of it was his nudging these people in the direction that he wanted them to go. Is there anybody out there capable of doing the same thing?
Well, there probably will be going forward. Right now, I think Wall Street is getting punished by the market, not anyone in the Attorney General's office. And that's probably a more painful form of punishment because Spitzer went after high-profile cases, but to my knowledge, didn't really inject any kind of reform across the board. I mean, even you talk about investment banks and analysts having more of a wall between them. I don't know if that's really true. I think there's an inherent conflict of interest in the banking industry that will always be there.
Maybe so, Terry, but I know analysts and I know investment bankers, they're staying away from each other to this day.
Yeah, and the job of an analyst is no longer considered as important or lucrative because you're not swinging the investment banking business as much.
Exactly.
So, I do think he had an impact. I think he will be missed because despite all of his other faults, he was very smart. And he was behind trying to work out this mess with the insurers and the bond insurance that we've been talking about at the state level. I do, however, think that Andrew Cuomo will be quite happy to fill
the current
his shoes.
General who has aspirations to be governor. In fact, AG is often called aspiring governor. But Gary Kaltbaum, what about one thing I think that we'd all agree needs correction? the rating services. This is something that not only Andrew Cuomo but also Governor Spitzer were very interested in, particularly because of the subprime mess. We had these mortgage-backed securities that clearly didn't deserve AAA, that were given AAA by S&P, Moody's, Fitch, etc. He wanted to take aim. Is there anybody else that's going to pick up that cudgel now?
I sure hope so. Look, to this day, the rating services have AAA ratings on an AMBAC and an MBI that have to go out and pay 15% on their debt and almost was unmarginable. So there is no doubt those are false AAA ratings. Unfortunately, I've been saying this on my radio show for months, the people who should be overseeing this are doing nothing. So it's kind of a shame that somebody like Spitzer is now out of the way. I'm hoping somebody else picks up the slack. I'm not sure that's going to happen. I try to yell and scream about it to my 8 people listening on my radio show. I'm not so sure they're listening.
Peter Schiff, what do you think of that? I mean, do you think that there's a chance that we will continue to see reform? What kind of reform should it really be on Wall Street?
Well, I think that there needs to be a lot of reform, but it's not just the rating agencies that put these ratings on there. I mean, people believed them. I mean, when I first looked at these AAA-rated subprime securities, when I first learned about them, I couldn't believe it. I said, how can anybody buy this? These things should be rated F. I didn't even have to look at it to know that they were going to default. I mean, so everybody's looking the other way because everybody's managing everybody else's money, and they're all getting a piece of the action, and no one's got skin in the game and you know, real money.
You were a big supporter of Elliott Spitzer.
Well, I mean, I think some of the things he did were good, but I said I don't think he went far enough. I think we need more reform. I'm a big critic. You know, look, I'm highly regulated by the NASD and the SEC, and I think, look, these government entities that supposedly regulate the securities industry, I don't think they're doing the public any good. I think what they're doing is protecting the monopolies, near monopolies of major Wall Street firms, making it a lot harder for small firms like me who have to deal with all this bureaucracy, that don't have, you know, big legal departments and big compliance departments. You know, it's harder for us. Meanwhile, I think the public has a false sense of security that they're being protected, but they're really not. I'd like to have more competition, less government regulation in the securities industry, and have regulation by the free market. People looking for a good track record, looking for the competition for reputation. I'd rather put my faith in the market than the government.
Who would want to take on what Elliott Spitzer did and be reviled in all of Manhattan? You know, instead you can go after dry cleaners.
He got to be governor of New York.
See, yeah, he had a huge following because, I mean, he got a lot of people voting for him.
It helped to get him elected,
to get elected, certainly. And I mean, I remember, I said this yesterday, I saw him in a restaurant when he was Attorney General. People were hitting him on the back saying, great job, keep going, Elliott, keep going. And Gary, I think that there was some real goodwill, at least at that time, for people who had made investments based on what analysts had said was good quality when it really wasn't.
Look, all investors ever ask for is a level playing field. And throughout the last few years, and you're seeing a lot of it now, there isn't a level playing field. Some of these big financial companies are just too big, and they have to be saved because they're too big. And that's not the way markets should work. I say let them go. And I want to mention something that happened today that I noticed. The head of the SEC came out to literally defend Bear Stearns when there was rumors of a liquidity problem. Why is the head of the SEC coming out to defend the company? Let the company do that. I just think that there's too many people, closed hands, all part of the problem, and they need to break away and let's split this whole thing up and get back to a level playing field where
Victoria,
investors have a good chance.
the irony is that's exactly what Elliott Spitzer would have said he was trying to do. Not only Elliott Spitzer, but also Andrew Cuomo as Attorney General. But it was the way in which Liz mentioned how popular he was when he came in here as governor. He came in with over 70% of the vote. I mean, it was very extraordinary. But immediately after he came in, he got embroiled in this scandal of using state troopers to try to go after his political enemies in the Republican Party. The guy couldn't stop himself.
Right, right. He was a prosecutor in the past and going forward and always will be. But it was a great path to power for him, and that means that someone else will fill his shoes.
All right. We've got the Dow up 354 points. Citi and American Express up more than 7% each.
We'll take it. More going to come right here on Fox Business.
It started early this morning when the Fed announced it would shake some credit loose that had been clinging to the side of the walls, and what a day on Wall Street that followed.
I happened to be watching at 9:30 just as the market opened. It was amazing to see the market jump in increments of 20s and 30s and 40s, and it went all the way up to 352, which is where it is settled now. We got about another 14 minutes before the market comes to a close, but I should mention the Dow is the least attractive indices right now. All the other indexes are up above that amount percentage-wise. So it is a good day for investors.
Yeah, those who are long the market, certainly. In fact, they were so happy over the Fed's plan. And basically what that plan involved was making $200 billion available to troubled Wall Street banks. Not just giving it to them, but making it available. Instead of lending it overnight, they'd have 28 days to pay it back. The rally that followed, the big question is, will it continue? Our Fox panel back now, including Tracy Burns on the floor of the New York Stock Exchange. Tracy, we'll start with you. As we finish out the session, we were languishing a couple of hours ago up about 250 points, and now suddenly we're up more 100 points higher than that. What do you think is at work in the end of the session here as we get close to it that pushed it so high?
We were seeing real buying. That's what traders were saying. We're actually seeing money coming in. You know, this morning when we were up about 200, there was a concern that this might be a lot of short covering. Is this for real? Is it going to sustain? You know, that's actually something we were saying earlier in the day. And watching it, real money actually did come in. There's a lot of buy orders coming in, and it's not just people covering shorts. And I think that was something that everyone was waiting to see. I do have to say, though, the volume is still light. They would have liked to have seen us cross well over $2 billion, and we didn't. So it's not like a ton of money poured in, but it was good news, and it did hold. And quite frankly, we have to remember, too, we've been beaten down so much that even giving back this 350 points is nowhere near us giving it all back by any stretch. But nevertheless, it's a good sign. And Alan Valdez said it earlier, there's a good vibe down here, actually. And, you know, to Gary's point earlier, when the SEC chairman came out and said, you know, that he believes bears liquid, whether or not he should intervene, it moved the market, and that's when we started popping back up, because we had pulled back a bit, and that was enough to turn us back up and enough to convince people to get back in here for a little bit.
Terry, the market so wants momentum on the upside that it hangs on the slightest rumor. I mean, what happened with the Fed was much more than a rumor. It was a detailed plan involving central banks and other countries as well. But these rumors are propelling the market right now.
Yeah, I mean, mission accomplished for the day. The Fed wanted to breathe some life into these financial firms, which have been making new lows by the week, and it worked. But the question is, how long, you know, will it last? And you know, you typically, when you have these types of situations, a recession, a bear market, a credit crisis, some big firms go under. A big bank goes under. A big Wall Street firm goes under. That's what happened in 1991. Drexel went under. Will it happen again? I don't know. They've staved it off.
Peter Schiff, Thornburg's pretty close, although today it's up more than 100%, still $1 and change. But there was a lot of talk about whether they could sustain their business operations.
Well, sure. But, you know, what happened today in the market, you know, every time we have one of these, the Fed is going to save us, relief rallies, they keep it, every time they say, oh, it's real buying this time. But yet, yesterday we were on the absolute lows for the move. And, you know, what the Federal Reserve is doing today, it makes me think of the history books, and they're borrowing a page from 18th century France. You know, there was a currency called the assignat, which was backed by mortgages on church property. And it eventually led to hyperinflation, and the assignat became completely worthless. So what we need now is Austrian economics, not 18th century French
Did you learn that at Berkeley?
I don't remember where I learned it, but I remember.
They teach that in econ, Gary Kay, at Berkeley.
Boy, I'm telling you, I don't know what the heck he's talking about, but okay. Look, let me just say a couple things, and we've done this a few times in the last few months during the bear market. First off, it's one day. It is a great day, and we'll take all we can. But just remember, in bear markets, your biggest days are in bear markets. The top 10 largest NASDAQ days were in 2000 to 03. So let's get more than one day. Let's get more confirmation that the worst is over. Keep in mind, the Dow just dropped 1,000 points in 8 days, so it was due to bounce. The Fed helped it to be a big bounce. I want to see more. I'm from Missouri. Show me.
Yeah, that's right.
All right. Well, Victoria, we don't. The big difference between France 200 years ago and the United States today is we got a pretty solid free market system right here in the United States. People out where you are in Silicon Valley are actually constructing things and building businesses based on what they are doing and inventing.
Oh, yeah. I spent last week at a conference in San Diego that was all about the future of technology. And let me tell you, entrepreneurs out here do not know the definition of recession. Of course, they're thinking long term. There's no shortage of innovation here. As for the stock market, you know, I agree with Gary. This is it's almost worrisome when you've got a bear market like this and we see a bump in such a short period of time. What you really got to see is corporate earnings, CEOs coming out with more optimistic predictions. And that hasn't been the case yet.
And Tracy Burns, the feel on the floor right now, if you could describe it in a word or two?
I mean, it's really, people are up, people are happy, but I do have to say, someone pointed out earlier that it cost $200 billion for a 300-point rally.
Great point.
How much does 367 points cost?
We'll be right back. Stay tuned.
Okay.
You think the Dow is charging ahead by more than 379 points. Look at the NASDAQ, up 70-plus points. I believe it's about 78 points. That's a gain of 3 2/3%. And if you're picking apart the NASDAQ, which is now at 1 billion shares in trading volume, Google, which yesterday hit a 52-week low, is now charging up about 6.25% or $25. Guess, David, yesterday was a buying opportunity for Google.
It was indeed. Had we known yesterday, of course, the Russell 2000, if you could trade the whole as a spider, you would be doing very well. It's up 4.25% right now. Look at the Russell 2000. I think you're about to see a change. Give that another click. Give that one more click unless my Thompson is down. Well, at any rate, it is the largest of all of the indices percentage-wise, charging to the upstream. And, of course, that represents a lot of the main street stocks, the smaller and mid-sized cap companies. So the market's doing pretty well. The question is, how long will it last? Will this just be one-day rally in a week? Victoria, you were beginning to speak on the positive side about moves that are being made out in Silicon Valley to actually grow business. There's still a lot of cash on the sidelines, right?
Yeah, there is, and it's funny you mentioned Google because that was one of my stock picks on last week's Forbes on Fox.
It was indeed.
So
Congratulations.
I was right once. Google, Amazon are two companies that I think are very interesting right now because they're taking advantage of the cheap revolution. They're offering services at a very low cost, and lots of the startups I talk to are using Amazon's online storage system and using Google for enterprise software, Word and Excel, stuff that they otherwise have to buy from Microsoft and spend a lot. So I think those are two very promising companies that are following promising trends in technology.
That's the thing, I think, Peter. As an investor, you look at things and you follow those promising trends, what looks like a very solid and well-run company that has a great product, right?
But the problem is when there's a promising trend...
I knew he couldn't just say yes.
You're not going to be the only one that sees it. I mean, if everybody sees the promise, it's priced into the stock. Now, if you can find something promising that nobody knows about before anybody knows about, that's the right thing. But to jump on a bandwagon is not going to make you any money.
Peter, come on. Look, I agree with you with a lot of things, but the biggest winners of the last 20 years are IPOs that came public with great products, great innovations, great managements, and soared up 10, 15, 20
Google's
fold.
not an IPO anymore.
Don't sit there and jump down on it. Google was up 10-fold before it topped, and when you go back into the 90s, some stocks went up 50 and 100-fold. It's crazy to put them down.
Remember when everybody was talking Yahoo and there was no Google and Yahoo was everything? Who knew that Google was going to come along? How do you know what company is going to dominate search in 10 years? You don't know if there's another Google waiting to come in the wings?
But hold on a second. Hold on a second.
There's always somebody else that comes around to be the next great company.
Exactly. Not only that, Terry, but this is not a market of monopolies. I mean, this is a market in which sometimes you can have more than one or two or three or 100 of one particular product. It's a matter of choice. We have a free market economy.
Yeah, that is true. Unfortunately, it's also not a market of IPOs at the moment. And, you know, Gary is right. If you can get those IPOs early and pick them well, that's how real fortunes are made. Right now, though, we're in a bear market. There aren't many IPOs. I guess we're going to get the Visa IPO next week if they can get that off.
That Blackstone IPO? That thing is less than half of what it was. Look how hyped up that was.
You can always point to disasters, though.
I do.
You can also point to successes out there. The market is not a rigged game. It is a game that we can all participate in.
But I'm saying that in general, the market is overvalued and the economy is a disaster. We're going into a recession. Earnings are going to come under pressure.
Gary, go ahead.
Look, there has been so many fabulous companies with great innovations, drug companies with new great miracles coming out, and there's going to be plenty going forward. Nothing has changed about the great innovation of this country, and if you sit here and continue to talk negative every minute of every day, you're going to miss out on it, Peter.
Well, I think, though, in Peter's defense, Gary, I think that you and I, Gary, you and I look at things and say, great, these are companies that maybe one day are really going to do well. Peter, it seems like you're looking for that instant, gain that you really want to see every single day. There people who are different from you, they're okay with investing in a company that's not skyrocketing.
I'm not. I'm the opposite of that. I tell my clients to buy and hold dividends. I don't look for quick gains, but what I'm talking about is a big macroeconomic issue. We're coming off the biggest bubble economy in our history. We had a phony prosperity. We didn't save enough. We borrowed trillions of dollars from the world to consume. That bubble has burst. We're going to have a significant retrenchment. We're going to go through a gut-wrenching recession. That's going to go for years, and it's going to knock down the stock market.
Know it, Terry, from the way Peter's talking, but let's take a look at the Dow Jones Industrial Average. We haven't seen it go over 400 in quite a while. It has just done that with the remaining seconds. It is over 400 points right now, and this is not a day you can sneeze at.
Biggest gain in more than a year, and if you were short this market, you're not very happy.
I'll say
not very happy today. But back to Gary's point, the biggest gains, daily gains, occur during bear markets. It happened in the 70s. It happened in early 2000s.
This is a selling opportunity.
I'm still trying to find out what a blind dog in a meat house is, by the way.
It's a dog, Gary, that runs into the meat house and starts eating everything, even the dreck.
Okie dokie.
Got it.
Right. As we hear the closing bell on a remarkably positive day, the Dow Jones Industrial Average over 400 points. It is yet to settle, but it looks like it might be settling above 400 for the first time in a long time. The trading days come to a close, but the business day continues. And here's the financial news you need to know today. Well, is today's move by the Fed an indication that policymakers don't have to slash interest rates again to help boost the economy?
Yeah, are things really that bad? And how much more do they have to do to prop up this market without totally blowing up inflation? Let's ask our Bulls and Bears panel. We have Mike Norman, Peter Schiff, Tobin Smith, and Gary B. Smith joining us. Gary B., does the Fed need to keep cutting rates? You know, we saw today the Fed funds futures pits started to get very frightened after this $200 billion move.
Yeah, exactly. You know, there's two questions, Liz. Do they need to, and are they going to? And let me just go to maybe the second part of that. You know, everyone says, oh, my gosh, you know, the Fed is not a slave to the market. I think that's kind of naive. I think the Fed looks at what the market's reaction to their moves, implied or otherwise, almost every single day. And I think the moves they made this morning to kind of basically rescue the financial industry, at least throw them more of a lifeline, I think they're sitting back and saying, yeah, that was good. So in answer to your first question, now I think the odds are much less of them lowering rates next week when they meet.
Toby, you know what bothers me about this Fed move is that so many people inside the Beltway like it. It's getting applause from Christophe. I'm reading all of the various politicians on both sides of the aisle that are coming out and saying what a great silver bullet this was, is going to solve all the problems.
Well, it's sort of intriguing to me that, you know, look at the last 7 months here. We were in this, despair in August, like the world was coming to an end. Boom, they come out with this, hike. Then we get into September and people are, boom, they hit it again. We saw this January 22nd, the day after we had the big meltdown in Europe. And then yesterday was another one of those, completely oversold, throwing everything out, hedge funds getting blown up day. And they come in today. It really sort of builds the feeling that, I'm mother fed and I'm going to get in there. And if you just get out and cry enough and wail enough, I'll come in and help you out. It sort of reminds me of my dog who wants to go out in the morning. But I do think that what's different maybe about this.
Let the dog out, Toby. Forget the Fed. Let the dog out.
Exactly. But I do think that maybe what's a little different here is what they're trying to do is get outside of the banks. Remember, the Fed, if they vote for it, could actually take this liquidity and bring it to partnerships, bring it to LLCs. It doesn't just have to go to banks. This was the first step today to try to bring this massive amount of liquidity to the partnerships and the other non-bank banks that are really tied up. If they are successful in doing that, then this is a significant move.
That are really tied up, Peter, because they got themselves into trouble by relaxing their own standards.
Well, of course. First the Fed ignites a fire, and then they throw more gasoline on it. That's exactly what they're doing. It's interesting. Yesterday you had the number 2 guy over at PIMCO was actually calling publicly for the Fed to come out and print money and buy up mortgages. And the next day, here they go doing exactly that. But, when you have the bond vigilantes, the people who are supposed to be the watchdogs that are anti-inflation, calling for more inflation. I mean, what hope do American savers have when everybody is wanting inflating?
Mike, the reason why we chose you last to speak here is because we wanted the market to settle. Yes. Because every time you hear the market goes down, the market is settled. It's still going to be up today. Mike Norman.
Have me on after 4 o'clock all the time. That's obvious from the settlement today. Look, to Gary B's point, at least what's implied in the Fed fund futures market today, there's less of an expectation of a rate cut, or at least as large a rate cut. Look, we went from about a 50% probability for a 75 basis point rate cut next week to about a 39% probability, so that's down. 25 basis points is a given. It's for sure. 50%, 50 basis point is about 59% right now. So you might get that, maybe not. If you only get the 25 basis points, the market might have a day or two of, pullback, but it could be good for the dollar. It could be negative for gold and these commodities that have been on a wild rally on the idea that the Fed is going to continue to lower and lower and lower and lower. This addresses something unique. It's a new tool in the Fed's arsenal. It's not about price. It's about quantity. They're supplying the liquidity.
Interesting stuff.
Thank
All right.
you. No announcement.
Thanks very much.
$200 a barrel for oil? Come on. But Goldman Sachs, they were actually among the first, aside from Stephen Lieb, to say $100 a barrel a while back. They say it could happen. And today at $108.75, you could kind of see how that would happen. Yeah,
of course, there were a lot of naysayers back then. There are a lot of naysayers today of Goldman Sachs. Other industry analysts say oil will stay in its current range, may even drop to the $80 mark. So what would either extreme mean for the economy? Let's toss that to the bulls and bears. Let me go, Gary B., first to you. First of all, you think the price is going to go up or down in the near future?
I think it's going to go up a little, and then in the longer future, which for me would be 6 months, I think it's going to go back down.
That was the second question. Long term, you think the trend is down. Why?
Well, I'll tell you what, I think when the price of oil goes up, we've already seen it. I just saw figures yesterday. Mass transit use is at a 50-year high. So what happens then is demand goes down. But if prices go up and stay up, we just have more of an incentive. Industries, we've already seen it in the alternative energy, plus the oil industry itself will start to really put the screws on improving efficiency to get more oil out there. So the market will work in this case, and then maybe the short answer to your question on the economy, if we continue to see higher and higher prices, I see very little impact on the economy.
Tobin, go. What do you think?
Well, look, at the same time Gary was talking about those numbers, Chevron and other guys from the Gulf of Mexico came out yesterday and said, guess what? Our new production in 07 was 15% below 06. Why? It's harder to find this stuff. I mean, the reality is 80% of recoverable oil are in national oil companies that are outside the United States, that are not friendly to the United States, and it's a two-edged sword. I strongly believe that we're going to be at the $150 level in oil before we're at $75 level, simply because look at the available oil. We still only have about 2.1 million of extra barrels per day available for shipment. That means that we're still very tight. Mexico production down, Russia production down. Basically, all production is down of light sweet crude. So, guys, it's 125 before it's 75.
Mike, you could go back to the early 1900s and see that margin of a 2 million per day barrel.
Oh, that's not true, Mike. It was 5.5 million. You're not going to produce 20 million barrels per day over your consumption. The price is going to collapse. Come on, Toby. OPEC, look, there's nobody in the oil industry right now in the business of producing and merchandising oil will tell you that the fundamentals justify this price. It is pure speculation. This $200 call that Goldman came out with, this is the super spike scenario. It's a little bit, that
that's
requires.
What they said about 100.
But Liz,
that's what
you're right.
I remember them saying
that.
super spike, $100.
But the fundamentals were different in 2005. You did have, tightness in the market. You're actually seeing an expand. You have more capacity. Saudi Arabia is building out capacity. You see OECD consumption, the big industrial nations, actually going down right now. Gasoline consumption in this country is flat. It's the first time practically ever in history that we've seen something like that. So I think the price is going to come down. How far? It's hard to say, 70, 80. But
I think the fundamentals do justify the prices. I think they justify higher prices. Oil prices have already doubled 4 times in the last 8 years. I mean, why can't they do it again? When oil was under $20 a barrel, I was forecasting $100 a barrel before the end of the decade. It's gone up 5 times since then. So what's another double? And again, you have to look at what's driving it. That's driving it is global inflation. If we keep printing money, then oil has to cost more. It's simple.
The dollar went down from 1985 to 1988, and oil went down too. So it's not always a direct correlation between the price of the dollar exchange.
You can always find an exception.
A dollar went. Well, that's right. You can always find an exception. And now the exception is an enormous amount of speculation.
No, it's not speculation.
Let Gary be in here for a second. Gary?
I mean, there's some, but that's not what's driving it.
Gary?
Just for a brief second. I want to get back to a brief point. Everyone thinks, not everyone, most people start to, they look at the price of oil and they think the rest of the world will stay static. For example, Toby's point about Chevron actually, producing less. That's true, but Toby has to remember, everyone has to remember for that matter, that's with current technology. Once that price starts to get up there, $120, $150 a barrel, boy, I'll tell you what, Chevron has a pretty big incentive to go to their engineers and say, how can we get more than we're getting now from conventional resources?
Last
that's what's going to
word
happen.
from Gary.
Okay, everybody be quiet.
Quiet. Was that? What a quiet ending.
No, actually... We round out our show today with what you need to know. Gary B., you first.
Well, I'll tell you what, I've heard a lot of bears over the last few hours. I'm going to be the bull. I think the bottom for the Dow is in, and here's my reasoning. One, I think we successfully tested the bottom we put in January. Two, the advanced decline today was 5-1. Three, the Dow had its biggest up day since 2002. I mean, NASDAQ, the Qs, SPY, everything was up today. I think it was a great day. I think whether you call it the Bernanke bottom or not, I think the Dow is set for a good rest of the year.
All right, from the Gary B. Pop to Peter Schiff.
End of the world, folks.
Well, look, my message, look, you got to study your
Particularly
history.
in light of what Gary B. just said.
Look, backing paper money by mortgages doesn't work. They tried it in 18th century France when they backed the assignee
Not back to 18th century France.
That's my point. That's what Ben Bernanke is trying to do.
There was no central bank in France.
But they had paper money and it didn't work, and it's not going to work now. And when you try to replace your balance sheet to swap out treasuries for mortgages, and you're going to issue paper currency backed by mortgages, that way leads to hyperinflation. We better get off this course fast.
I swear to God, I'm going to bring duct tape on here and put it over people's mouths when they don't listen. All right, Mike. Okay, now your turn.
The Bank of France was founded in 1800, and even with the fall of Napoleon and the French and everything else, it didn't collapse. So it happened before a central bank. There's a big misconception about oil and the way it impacts the U.S. economy. The U.S. produces only about 1.3 million barrels per day less than Russia, the #2 producer. We're the #3 producer in the world. So, high oil prices don't necessarily tank us like it would a country like Japan that produces nothing. Last year, about a third of what we spent on the consumption of energy, we recovered through investment in the energy sector, which is huge. And that doesn't even count profits at energy companies, et cetera. So you can't just say, look, this
We're
guy,
still a net importer, though.
The genius, which is good. Look,
no, but we pay for oil. We're net importer.
Guys, this is what do we need to know, and we got to move on. Toby, what do we need to know? Just talk over these knuckleheads. Go ahead.
Yeah, well, first off, people always ask me, is Peter Schiff a vampire? Now we got proof. He was alive in the 18th century. All right, now look at. I would give Gary B's bottom move about 2 more days, and on Friday I would buy the SKF, which is shorting the financials. Now I love Gary, but I think he's dead wrong here, because when you look at the multitude of news that is about ready to come in here on the write-offs, the additional $200-300 billion of write-offs, the whole issue now of writing down valuations on banks, etc. We're not done at all with the bank write-offs here, and I'd say we got another 1,000 points down before the real Toby bottom
Wait,
comes
so
in.
Tobin, tell us one more time, the SKF. That's an interesting play here.
Yeah, it's at 2 times the shorts. In other words, if they go down 10%, this ETF goes down 20%. You want to buy them when you have these short covering rallies. It's been pointed out before. 10 out of the top 10 rallies in all-time history happen in bear markets because this is a short squeeze. This is not a bottom.
Would you go with that, Peter?
This is a profit-making day.
As I said, a bear market falls a slope of hope. And when you get these 300-point moves up, it creates a lot of hope. People think, oh, my God, I'm glad I didn't sell into this rally.
By the way, not that numbers matter, but it was 416 points.
All right, 400 points.
Yeah, another 100 points.
It's only dollars. What difference?
Our thanks to our panel. I want to mention that tomorrow...